Well, good afternoon, everyone, and thank you for joining us for this session on cross-border expansion for technology companies. My name is Namir Hallak. I'm a U.S. cross-border tax managing director here at Anderson from beautiful Vancouver, and I'm joined today with my colleague and managing director from Calgary, Savneet Talwar.
Hello, everyone. I'm from Calgary, and then it's not as sunny as Vancouver today, but definitely hoping for more sun.
We'll start out with some quick housekeeping rules here. So, as a NASBA accredited sponsor, we're able to offer continuing professional education, CPE credits for today's webinar. In order to qualify, you'll need to answer all three polling questions that will appear during the session. These will pop up at various times throughout the webinar, so please make sure to stay tuned and respond promptly to each one. Um, with regards to questions, we do encourage you to ask questions throughout the webinar using the Q&A function. While we may not be able to address them immediately, we have set aside about 10 minutes at the end of the session to go through as many as we can, and we will be looking through the questions as they come up during the hour. So we do welcome your engagement. There will also be a survey. So once the webinar ends, a short survey will automatically pop up. We would really appreciate it if you could take a moment to complete it. Your feedback is really valuable. It helps us improve future webinars and to continue to bring you relevant and valuable content. The other thing is there is a live transcript option on the very bottom there. You see it says CC. So if you'd like to enable closed captioning, please simply click on the live transcript option at the bottom of your Zoom window and select Show Subtitles. This can be helpful if you're in a noisy environment or prefer to follow along with text. All right, now to the agenda. So the US, the US market is a massive opportunity for a lot of Canadians, but it's also a landscape that continues to shift. So our focus today is really on tech, and one example we're going to thread throughout the conversation is a SaaS company, a software as a service company. So if you're a cloud business company in Canada, there's a good chance you have already felt one way or another the gravitational pull of the US market. And for many years, cloud and SaaS businesses, they kind of operate in a bit of a gray zone. The rules were really designed traditionally for the old economic realities of how businesses were done. So for factories or for distributors, and you're really dealing with like widgets, like tangible goods. You're not necessarily dealing with, subscription software, or you're not dealing with, for example, a distributed engineering team or what we know as these usage-based revenue models. In 2025, so about a year ago, January, the IRS finalized and proposed a set of rules that really fundamentally reshaped how cloud income is going to be characterized, how it's sourced, as well as how it's ultimately taxed. So today, what we're going to do is we're going to walk through some five critical questions that we think any SaaS or cloud business or any tech really industry business needs to address as they expand into the U.S. These really aren't just looking at just the tax or the legal technicalities. It really impacts some of the strategic decisions that can have a profound impact on your company's ability to scale, attract investment, good talent, and hopefully avoid some costly mistakes. So our agenda will start out with, hey, you might already be taxable in the U.S. Two, how are you funding this U.S. expansion? Three, a question that comes up quite regularly, where should my profits actually reside? Four, investor diligence, what should we flag, once the time comes to exit the business or other due diligence flags are triggered. And then finally, designing a structure that you don't have to unwind later, in 18 months, it's more arbitrary. And with that agenda, I will let Savneet dive into you might already be taxable in the US.
Awesome. So you might already be taxable in the US. So the biggest myth out there is I don't have a US corporation or a US entity. I'm not taxable in the US. That's actually incorrect. There are a lot of trigger points that could cause a US tax exposure, and some of those triggers could just be the US customers or any contractors. Maybe you just have a salesperson in the US, and that could cause a filing in the US. So I think the biggest thing is, do you have a US trade or business? right? So the US trade of business, usually it means something that's continuous, regular, and that you're doing regularly in the US and it's considerable. That means it's just not one transaction and it's in a certain big amount. And if you're doing that, you might already have a US trade of business. And when I look at that from a Canadian tech company point of view, you're probably thinking about, hey, I have a salesperson who's trying to drum up this sales for software for me in the US. Well, that's actually a US trade of business. So the threshold for US trade of business is very, very low. So if you have any presence in the US or you're even dealing with US customers, you might have to start thinking about filing in the US. And any trade of business means you need to file in the US. Whether you're taxable or not is a different thing, but it's definitely required of filing in the US. And there's a form called Form 1120F that corporations need to file in the US when they have a US trade or business. And when you look at the taxability, whether your business is taxable or not in the US, you look towards a concept called the permanent establishment, which usually is an office or a place of business. It doesn't have to be an office per se, a building. It could be you could have a person working from their home, which could cause a permanent establishment. So those are the things that you look at. And when you have a permanent establishment, that's what causes the taxability, right? And those are two important concepts. So if you might ask, I have a US trade of business, but I don't have a permanent establishment. Do I need to file a return in the US? My answer would be yes, because there's a treaty between, so I'm just talking about US and Canada, and every country has their own treaty. So if you look at the treaty between US and Canada, then the treaty clearly defines when something is taxable or not. But then when you say this is not taxable under the treaty, you still have to file a form with the IRS to say, hey, this is because of this treaty that I'm not taxable in the US. And so those are the important things to remember. You might still have a filing, even though you don't have a permanent establishment. And if you have a permanent establishment, you are likely taxable in the US. And so it's important to make sure those filings are intact, especially when you're looking at tech company and how fast everything is changing right now. And when it comes to the states, it's a whole different ballgame. And I always say this, Namir and I will joke about it, like 50 states is 50 countries, and every state has a different rule. So the treaty between US and Canada is actually at the federal level, but the states have their own rules. A state can come and say, hey, I don't follow this treaty, so I don't care about what you did on the federal level, but for the state level, it's actually taxable. So you might end up filing or being taxable in the state, each US state, but not taxable at the federal level. So those are the things that you need to think about when you're starting or doing a business in the US, whether it's through a Canadian entity or by setting up a subsidiary or a partnership, etc. We'll talk more about that in the future. Even a single salesperson could actually cause a permanent establishment or make you taxable in the US. So there are a lot of triggers there. So just make sure when you start doing business in the US, you get in touch with somebody who knows cross-border tax and understands it, understands the treaty between US and Canada and knows the rules to help you with this.
Yeah, and so neat to your point, I mean, I think a lot of times when clients are concerned about whether they're creating exposure, whether at the federal or the state level, often they think that there's permanent establishment either means that they must have a brick and mortar store in the US before they're being exposed to US federal taxes, which we know is not the case.
Right.
And and then with software, or tech business, they're often doing exactly what you're mentioning. It can either be a salesperson is going down to the US to help you, drum up sales. It could be that you have an engineer or a contractor, all those things, which, not only could they trigger payroll and state income tax obligations, but you might also have a state income tax obligation for the entity as a result of having those US employees.
Absolutely. And I think those are the triggers there, right? So the moment you start doing something in the US, let's talk about tax and see if you're taxable there, or at least you need require filing. Because it seems like, hey, you just have to declare you're not following a treaty, but that also comes with a schedule which talks about how you meet the treaty. And if you don't file that schedule, the penalty is $10,000, and you don't want that exposure. And it's super important that we make sure the filings are in place beforehand. And so you're not exposed to those penalties, even though you are not taxable in the States.
Yeah, and like if we walk through just a quick example of what that can look like. So if you have a Canadian SaaS company and they have, let's say, a handful of US customers, and let's say they decide to have a remote sales rep in California, and then the company says, well, we haven't really set up a US entity yet. We're still just doing things from, having just a sales rep in the US, they're negotiating deals and providing support. California doesn't follow the treaty.
Mhm.
So from that perspective, the company may be required to file, state income tax returns, collect sales tax on its SaaS subscriptions. But again, even having that dependent agent in California, it might trigger something even at the federal level, where at minimum, to Savneet's point, you may have to file a protective return to claim some of those treaty benefits.
Exactly right. And I think dependent agent is the key there, right? Independent or dependent agent. So there are things in the treaty that we need to make sure before we say you have a permanent establishment in the US or not. And that's one of the things that Namir talked about. Okay.
So let's go into kind of, probably one of the most critical questions, which is, what is the right entity that you're going to use to set up your cross-border operations and trying to make sure that hopefully you're getting this right from the start. And I think, this is probably one of the most consequential decisions in terms of how do you structure that entry into the US market. And, the choice that you're going to have is really, are you going to operate directly into the US market entry through your Canadian entity? Or are you going to look at establishing a US subsidiary, which can have really far-reaching implications, not just from tax compliance, but also from, investor perception when they're understanding who are they actually dealing with here, and the long-term scalability of where do you want to go with this entity as you grow your US footprint. So I'll start with an understanding here of what happens which is kind of a very typical way of scaling this. You start by operating through a Canadian parent. So when you operate through a Canadian parent, that's a pretty, I would say, simplest route from all the options available. I would say that's maybe the simplest route. There's no need to really set up a new U.S. entity here, and you're starting to sell to U.S. customers. But again, as you grow your footprint, you might say, "Hey, I think I need to start hiring more U.S.-based talent to kind of scale this and move it forward." And with this kind of model, you have to remember that if you have a Canadian parent that's operating in the US, it does have some risks because once you start contracting, whether you have US sales or start having US personnel that you're hiring, sales reps or otherwise, you're getting more and more exposed to a US federal and state tax exposure. There's going to be filings, and you might also have some, potential withholding tax obligations as well. So, and as Savneet alluded to earlier, even if you're protected from US federal income tax by the Canada-US treaty, you might still need to file to be able to claim those benefits. And again, with states, a lot of them, they don't recognize the treaty, so they may also impose some income or sales or payroll taxes, depending on, whether you have economic nexus or other types of nexus, or even the presence of those remote employees. So there's a patchwork of different compliance headaches that can expose the Canadian parent company to U.S. Taxes. Now, the other model is having a U.S. subsidiary or a Delaware C corp. And for a lot of SaaS or tech companies that are really serious about, hey, I really want to have a U.S. presence, they have these U.S. ambitions, then they're going to form a U.S. subsidiary. And typically, I would say, a C corp is one of the first considerations, and that can be seen as almost like the gold standard of how you're going to set up a U.S. entity in the U.S. And what that does is it's going to ring fence, a lot of your U.S. activities so that you can limit your liability and tax exposure just to that subsidiary rather than having it exposed at the Canadian parent level. And that usually will also align with what the US investors are also expecting. Or if you're dealing with venture capital and institutional investors, they're going to be familiar with this and they're going to prefer investing in for example, a Delaware C Corp. And this model also makes it a lot easier if you're deciding to move forward with onboarding US employees or you're contracting with more US customers. And it allows you to manage the compliance in a scalable way. But really, there is no one size fits all. There's no one answer that is going to make sense for all ways of operating your cross-border business. It's really going to depend on your goal. And so if you're only testing the market or you have really minimal US activity, operating through the parent may, the Canadian entity could work temporarily, but you just have to be aware of the risks. Like we said, there's a minimum of filing exposure. But again, once you start to, you're hiring a US team, you need to start raising some US capital, you want to scale quickly. The US subsidiary is going to be almost always a better choice. So you really want to make sure you're having those considerations early, talking about what are your goals, and making sure that you're avoiding costly mistakes that are going to have you restructure things later as create more value in your business. And I say that because the flexibility you want to have early on is going to have you answer questions about where do you want to be as a business? Where do you think you're going to be building value? Because it is really expensive from a tax perspective, but also administrative burden of trying to unwind a structure that isn't going to work for where the business is headed. So you really want to build a foundation that's supporting not only where you are today, but where do you see your future growth? And that's got to be a model that matches your risk profile, helps you with your compliance, and positions your company for your not only US expansion, but investment and how you want to exit later. And with that, we're going to go to our first polling question.
Alrighty. So the first polling question here, which of the following can create a US filing obligation for a non-US tech company even before it forms a US subsidiary? A, only opening a physical office in the US. B, US customers, remote employees, or contract negotiation activity in the US. C, only raising capital from US investors. D, only registering a Delaware corporation.
I want to raise just a quick point here too, Sung. I know
Yeah.
we mentioned when you have a U.S. entity or U.S. subsidiary, we talk about a Delaware corporation. And I want to clarify that, a Delaware corporation, sure, that is a common way of setting up a U.S. entity, but that's not usually a tax answer. I think usually, the Delaware corporation is because of the legal precedent that you have when you're setting up an entity. So it's more from a legal perspective why that could be a best choice when you're operating across multiple jurisdictions. But it's not always, Delaware Corporation is not necessarily always the right answer or the best answer from a tax perspective, as well as, where are you actually operating, where are your customers, and how are you growing your business?
Yeah, no, absolutely. It's like if you're a Delaware corporation, doesn't mean that if you do business in California, you won't be taxable there. You will still be taxable in California because of your nexus. And again, every state has a different rule, so it depends upon what it's going to tax you on. But it's where you do the activity, you get taxed on that. Delaware is like people, and again, it depends on people where they want to register. It's one of the easier states to register and do filings in, and that's why people prefer Delaware. But it doesn't take away the fact that you have to, you still have to pay tax in the states where you have activity.
That's absolutely right. Yeah, you have to really think about it. And it's really looking at the different lenses, not just federal, but the state and local tax that can really throw a lot of Canadian companies off in terms of the compliance and the risks of doing business in the US. And looks like a lot of our audience here got the answer right. It's they put answer B. And with that, we can move on to the next thing, which is financing and funding your US expansion. So why does funding your US expansion matter? Well, okay, once you start recognizing that, you are operating in the US, you've already talked about, what is going to be the right structure for you to operate in the US. I think the next critical question is, how am I going to finance this? And, this isn't just a financing issue. This is really looking at the structural decisions that can have, tax, legal, as well as investor implications. Now, the One Big Beautiful Bill Act that was enacted on July 4th in summer last year changed the U.S. tax rules so that companies can now deduct the interest expense more easily by changing the limitation using EBITDA, which is earnings before interest, taxes, depreciation, and amortization versus just EBIT. So they've made it so it's a lower limitation in terms of your ability to take that deduction. If that's what it is, it's more easily you're more easily able to take that deduction than before because it was a more strict limitation before One Big Beautiful Bill. So this affects how much interest you can deduct on intercompany loans and how you structure your funding models. And there are several ways in how you can approach this US expansion with funding, each with its pros and cons. And I wanna thread it back in here why this matters from a tech company perspective. So and with the cloud sourcing rules that came out last year. So when you expand into the US and you start providing cloud or SaaS services, the new proposed cloud sourcing regulations say that your income is considered US source if the service is being performed in the US. Not just because your customers are in the US, but because your people or you have servers or you have key activities that are happening in the US. Well, why does this matter from a funding perspective or a financing perspective? Well, it matters because where your income is sourced, whether it's US or Canadian, will affect how you structure your US operation and then how you're financing them. How are you funding them? So if your US entity is performing the cloud service, the income is US source. That means that your US entity will be taxed on that income. And you'll want to make sure, if you're running this business, that it has enough funding to finance it. So whether that's through equity or loans or intercompany charges, you want to make sure that it's able to cover its expenses and support the business. So that funding structure needs to match the economic reality of where is the value being created between your US entity or your Canadian entity. So if your US entity is the one that's delivering the cloud service, it should be funded and capitalized to reflect that role. Otherwise, the IRS can look at that and say, I'm going to challenge that structure and potentially deny you the deductions or reallocate the income. So what are the funding options? One of the options you have is equity. So the Canadian parent here just injects capital into the U.S. subsidiary in exchange for shares, and that's pretty clean from a legal and diligence perspective. It aligns usually with U.S. venture capital expectations. And there's no interest with that. There's no debt documentation required with it. The cons, of course, is that you can't deduct your interest in the U.S., and there's less flexibility in terms of how you're repatriating the cash out of it. On the other hand, if you do an intercompany debt, then here you have the Canadian parent company or the Canadian entity is lending money to the U.S. subsidiary. Here you can have the interest payments be deductible in the U.S., assuming it meets eligibility for it. And so there's a mechanism here for repatriating the cash out of the U.S. But again, the cons with this is you need to be mindful of, the interest needs to be at arm's length rates. You need to have really good documentation to evidence that, you have repayment capacity. There's risk if you don't meet some of those criteria. There's risk of that debt being recharacterized as equity if it's not properly structured.
And I think the important thing out there is the interest rate. And so when you think about it, it's a US entity, say, paying interest to a Canadian company. Then you look at the EBIT calculation that you talked about, or EBITDA calculation that you talked about, right? But I think the main criteria there is one, the interest has to be paid. And so
That's
it's not
right.
only important just to accrue it, it needs to get paid. And then you look at the limit. If it's not paid, then it's likely going to get characterized as equity. And so the first thing is the US company able to make that interest payment or not? Right? That's super, super important. And when you look at this, you go like, okay, it's deductible, that's fine. But then you go back to the withholding tax rules, right? And so I'll let Namir talk more about that, but it's something super important as well.
That's absolutely right. If you are accruing the interest, and for the sake of, papering that there is interest being accrued to your Canadian parent, but you're actually not paying it. I mean, this is where the IRS looks at this and scrutinizes, and especially when you don't have anything documented either, right? So if you have a loan arrangement or there's an intercompany arrangement where you're funding the U.S. subsidiary and it just sits there, and nothing is being repaid, there's no substantiation of, hey, what is the loan term? When are you planning to pay this back? I think the IRS will look at that and say this could be recharacterized as equity. And the issue with that is if it is recharacterized as equity, and then you're starting to get payments back of that, what you thought was a loan, between US and Canada, depending on what percentage ownership the Canadian entity has of the US, that could be a withholding. It's a leakage of your payment to the US, to the IRS of 5 or 15%, and you don't get that money back, right? So the issue there is you really want to make sure that if it is structured as debt and you want to finance this as debt, the nice thing about when you're paying this back as principal or as interest, there is no US withholding to the IRS. And that's a critical way of having a clean way of repatriating your profits back to Canada when the time is being repaid. With that, I think you want to talk a little bit more also about the service arrangements,
Sure,
Savneet.
absolutely. But before we move on, I just want you to think about this from a perspective of a person who's making the payment. So say the US company makes a payment to the Canadian company, right? So there are withholding tax issues that Namir alluded to, but that also comes with filings, right? So, and it's similar with other companies as well. So if you're dealing with your customers and they make a payment to a Canadian company, that could get caught up under withholding tax rules as well. So do those people actually want to do the paperwork to send some of the money to the IRS on your behalf? Do they want to do the withholdings for you? So that's super important for from that perspective is what does the market demand? Because when they deal with a non-US company, they actually have to do all those filings, which they wouldn't have to if they were just dealing with a US company. And so sometimes it's always better to see what the market is asking you for. Maybe your customers want to deal with a US company, right? So that's super, super important. As well as service arrangement. So say you're sitting in Canada and you've set up a US subsidiary and you're providing service to your US company, but you're an employee of the Canadian company. So essentially, US company should be paying for your time because you're sitting in the Canadian company. And because you're a Canadian company's employee, they should be reimbursing the Canadian company for your time. And that's what transfer pricing is all about, is making sure the costs and the income are in the right entity. So you shouldn't be deducting anything in the US unless you have a backup for it, right? There should be a proper calculation of how did you figure out how much the US company would charge the Canadian company? And that's it's super important that all that's figured out and all the transfer pricing and agreements are in place. So if you were to get audited, you already know that this is why we calculated it. And, I had the experts look at it, and this is why this much can be deductible. And this is not only from an IRS perspective, it's also important for future investors, right? They want to come and look at like, okay, the first thing they do is go back and look for like 3 to 5 years of returns and what have you been doing in the past. And this becomes super, super important that your documentations are actually in place and you're not just doing a random calculation to take a deduction or an income in one entity or the other.
Yeah, and I'll add to that, I think, the service arrangements are quite useful for, when you have an early stage expansion where, potentially your US entity hasn't really fully become operational just yet. So you have the Canadian parent that is, hopefully taking advantage of Shred, it's doing, R&D, and there's management happening here. So they want to be able to still charge the US entity for those services. And so you really need to be able to outline early enough, delineate what is the function and risks that each entity is taking on, and that's where the service fees and as Savneet alluded to, the transfer pricing documentation would be really essential. All right. And with that comes one of the questions that as you start, hopefully you have your US customers, you are making money, you're in a good spot. The next question is, well, where should our profits live? And I would say, this is a pretty complex and very debated question with cross-border SaaS in terms of structuring things. And I want to go back to why this matters from the proposed cloud sourcing regulations that came out in 2025. And the reason for that is the income from cloud transaction is now sourced based on where the services are performed, not where the customer is located. So they use this three-factor formula that's looking at, the personnel, if you have tangible or intangible property, to determine the source of income. And this tells you why you really need to be able to align your legal structure with your actual business operations. And, it shows you that what the IRS is doing is it's looking for alignment to where the value is actually being created. So if your US entity is performing key functions, it's using US-based servers, or it's employing US-based R&D personnel, then a lot more of your profits need to be allocated to the US. So a couple of things to think about with this is, profits, it needs to follow substance. And so what that means is the tax authorities, the IRS, they're expecting the profits to be based on, where is your value actually being created? Where are the key functions being performed? Who is actually assuming risks? And where are your assets? And in tech companies, that tends to be usually, your intellectual property. Where is that intellectual property being owned? Where is it being developed? You know, where are the strategic decisions being made? Who controls the product's roadmaps, its pricing, the customer relationships? If a lot of these are now being driven as you scale your business in the US, it's going to be really hard to justify leaving most of those profits in Canada. And with IP ownership and development, when you're in a SaaS company, for example, intellectual property really is your core asset. So if your US team is the one that is developing the core features or it's the one that's driving the innovation, I would pause and say, maybe the US entity is more entitled to a larger share of your profits. So look at those things, look at those questions, look at the commercial risks, who's bearing the commercial risks, customer acquisition, if there's, volatility in your revenue, who has authority to manage those risks. All those things are going to be critical in understanding how you overlay your transfer pricing, and that really needs to reflect the reality of your business. I want to caution this, and often you have your U.S. entity set up as either a service provider or a limited risk distributor. And again, if the U.S. team is the one that is driving a lot of the negotiating of the contract, managing your customer relationships, or driving the product development, those labels may not hold up under scrutiny. So, and these things matter because when the IRS looks back at this, it'll impact your ability to use foreign tax credits, your withholding, your cash flow, and your ability to reinvest into the growth of your business. And I would say the two other pieces that matter in this are, exit planning and investor perception. The location of your profits and where your intellectual property is has a major impact on your valuation and the mechanics of how your future sale or IPO will go. And investors also want to see that the structure is aligned with the commercial reality so that they don't have to go back and do a costly restructuring. I would say be conscious of this as a Canadian company that is a tech in the tech industry. If you're in a SaaS company and you're setting up a US subsidiary, have those thoughtful kind of questionings in the process to say who's handling the sales, who's handling customer support. Because over time, as that US team starts to develop, if you're using a US team and they're driving the product development, these things will change, where your company profits need to be allocated. And the further the structure, drifts from how your business actually operates, the harder it becomes to defend a structure that doesn't match that reality.
And I think I think you just have to plan for it. And also, the one thing that people forget is you could try and keep your profits out of the US, but you might get caught under other rules. So one of the other rules is net CFC tested income rules, which it was there earlier, it was called guilty. The acronym is it's just it basically taxes your intangible income with a formula. But now they've gotten rid of that name as well as the calculation. So now they look at the CFC tested income or the income that your controlled foreign corporation is making, and they can tax it in the US earlier than they actually made and it doesn't depend on when you actually move the cash, right? So you could get taxed on it right now. That those kind of rules can actually define also when those profits that are in the underlying foreign subsidiaries are getting taxed. And there's a similar thing on the Canadian side, and it's pretty different. So keeping all those things in mind, I think we can move to the next polling question.
On to the polling question. All
Yeah.
right. So under the 2025 final Treasury regulations, how is a typical SaaS arrangement generally classified for U.S. international tax purposes? Well, I guess before we dive into the technical answer, let's think about how SaaS companies actually deliver value today, right? So most SaaS businesses, they're not selling a copy of a software or a lease for a physical product. They may provide like ongoing access to their platform or updates and support, all that are pretty much delivered over the internet. So with the 2025 final proposed Treasury regulations, the IRS wanted to clarify how these modern cloud-based models should be treated for international tax purposes. So when you think about a SaaS offering, what are you actually selling? Are you selling a product or lease of a software, transfer of a copyright article, excuse me, provision of services through a cloud transaction, or a royalty in all cases?
Yeah, so here we're talking about the federal side, but I think it's also important to think about the state side, right? And I think about it like there's the 50 states with 50 different rules. And some say some tax software as a service, whereas the others say, hey, this is a packaged software. It feels like tangible property to me, right? And so I'm going to tax it like a tangible property. And guess what? The way these are getting taxed is very, very different. Every state has a different rule of how a tangible property gets taxed versus how a service gets taxed. So that you could have different like answers, tax answers, depending upon what kind of software you're selling
And
and
each state will be
content of.
different.
Yeah.
Absolutely. And looks like most of the audience got this right with answer is C, and that's right. So the 2025 final Treasury regulations really specifically addressed the cloud and SaaS transactions, and they clarify that, when a customer is getting, on-demand access to a software or computing resource over the internet without downloading a copy for offline use, that arrangement is classified as a cloud transaction. And so under those rules, a cloud transaction is always treated as a provision of a service, not a lease, not a sale or a royalty. And this really reflects, how SaaS companies are actually operating, right? They're providing ongoing online access and support rather than transferring, ownership or a copy of the software to the customer. So this classification really is reflecting how income is sourced and taxed for international purposes. With that, we'll go
Okay.
into investor diligence.
Yeah, so if I was an investor and trying to looking to invest in your company, what are the things that I would look at, right? So if there was a Canadian company doing business in the US, which meant just going to the next slide before actually.
Oops, sorry.
Oh, yeah, there we go. So if I was an investor and trying to invest in your company, what am I going to look for, right, before investing? So things to flag were, hey, this entity, this Canadian or any foreign entity has activities in the US. What does that mean? Do they have all the US filings intact? Have they done it properly? So they would go back, look at these years worth of tax returns and say, is we done right or not? Have they made sure that the treaty has been looked at from a federal and a state perspective? So super important. Are there any payroll tax issues? Have the payroll tax been paid? Has your sales tax been paid? So you might want to just run a mini diligence in-house and say, have we done this properly? And because if your goal is to, hey, I'm going to make this big company and I'm going to either get investors or maybe I'm going to branch out and sell this company in the future, the main thing is looking at what have you done so far? So it's not about getting to a point where you want to sell your company and then looking back and saying, I've done this right. It's about deciding right now, right? I want to do the right thing starting now. So when I reach a point where I've made enough, if this company is big enough right now, and then you want more investors to grow it even more, then everything is taken care of. It's harder to go into the future and think about what's needed, but if you start by doing the minimal, which is so that you can avoid all these penalties and backdated filings, it's really good for you. It'll save you a lot of money. It's harder to in the future to go and so say you're in 2030 and you've grown so big and now you want an investor in and the investor wants you to do like look at 5 years worth of returns and you haven't filed it. It's going to cost you way more to get the returns done at that point in time because not only you have to pay the fees at one go, but then you also have to pay for the interest and penalties, which could be way higher than the actual tax that we would have paid in those years when you were actually doing the activity. So it's always better to start sooner and do the right thing rather than go and look back and pay way more taxes. And one thing we have talked about earlier is the intercompany charges, the management fees agreement, your transfer pricing, any intercompany a transaction should have documentation. You should have agreements in place, and everything should be documented so that you can support it when an investor asks you for it, right? And any limited risk service provider documents should be in there. If the US team is driving the revenue, that's where your revenue should be. So making sure your revenue and expenses are documented in the right entity. Those are the things that an investor would look for before trying to invest in your company or trying to even buy it out, right?
Yeah, and Savneet, you mentioned this earlier. We see this quite often when we're involved, even whether it's on the compliance, planning, or due diligence. But with a Canadian tech company, often if they're preparing, let's say, for a Series A round financing, during the diligence, I would say the lead investor will often say that the diligence will fail when they're operating in several states. And if they have remote employees, but they've, let's say, never registered for state payroll taxes, or they haven't filed or all their state income tax returns, these are the kind of things that need to be remediated, before closing, or otherwise it could delay the financing or it could, increase the costs. But those are the type of things that you want to be aware of and be crossing your T's and dotting your I's on early before it becomes an issue that prevents you from getting your, for example, financing with Series A round.
Absolutely. And I think we've seen that quite a bit when we've been involved in due diligence projects as they look at all of it. It's not only about income taxes, it's also about sales taxes, payroll taxes. Is your revenue in the right entity? Is your expense in the right entity? Do you have documentation? That's where it starts, right? So that's the core for this.
Yeah, and they often think, well, I've got my risk mitigated at the federal level, but I think the state and local tax for Canadians tends to be one that is often overlooked. And then it shows up when you're doing the, Series A round financing, or if you're doing an IPO, or if you're looking at, some sort of exit planning. That is usually when these issues all of a sudden show up. And I think with that, we're going to our next polling question. All right. So next polling question is, what is usually the best guiding principle when designing a cross-border structure for U.S. expansion? And I want to say it's tempting for tech companies when they're going to the U.S. to say, let's focus on minimizing taxes in that first year, as opposed to, or copy what another startup did. Others might say, hey, I think we need to keep all the profits outside the U.S. That's the safest way to go. But really, you want to make sure that you're cognizant of well, actually, I'm probably going to give the answer away. So let's go through the answers. The first one is US minimizes first year tax at all costs. B, use the same structure as another startup is used. C, build a structure that aligns with actual functions, supports investor diligence, and will not need to be unwound later. Or D, keep all your profits outside the US, regardless of business activity.
Yeah, you almost gave the answer away,
I
Namir.
almost did. I realized as I was reading through that.
Yeah, no, I've often seen that people want to just spend less money initially and get into a structure which work for somebody else, right? And it doesn't necessarily work for everybody because you have different motivations. You're trying to get into a different market. Maybe it's not going to work for you. Maybe the structure is not right for you, right?
And it's definitely not one size fits all. It looks like we have most of the answers came in correct at answer number C, and that is the correct answer. The most effective cross-border structures are the ones that are going to align with your company's real activities, fully supporting transparency for the investors, and really built to last, has the flexibility as your business plan scales. And this means matching, the legal and tax structure to where are your people, where is your intellectual property, where are your business functions, and so hopefully you don't need to unwind it or overhaul your structure at the next financing or exit. I also want to mention that, if the value of the business is growing and your intellectual property is in Canada, exiting your IP out of Canada has a toll to it. So there is a tax consequence to it, and that's why planning early on this is critical.
Okay. Designing durable structures, and I think, like we talked about, not one size fits all. So I think you need to look at what you want to do in the future. What's your business plan? So your structure should reflect that. If your plan is to go big in the US and you want to hire a sales team in the US, you make sure you're raising capital or you're capitalizing your US entity there. So it's super, super important. Whereas if it's the other way around, where you're doing more work in Canada, it just makes sense to have the money in Canada, right? So it's not one size fits all. And then you have to lay down the clear legal and economic boundaries. So you have to decide if you're hiring salespeople in US, who's going to employ them? If you have a Canadian entity employing US people, you're actually exposing your Canadian entity to US taxes. Did you want to do that? Like, what is the effect of it? Right? So you got to decide where those people are going to sit. And again, some people just think about, oh, I can put this person in this entity for tax purposes. Guess what? You got to go look at your employment agreements. And whoever is listed on the employment agreement, that entity gets to take the deduction for their salaries and might get pulled into taxation in another country. So super important when you're hiring people, you look at which entity needs to hire this person, which would make sense, right? Which entity should hardly get a deduction, or which entity are you exposing to taxation as a result of hiring this person, right? Which entity needs to contract with the customers? If your US company is selling, say, software to the customers, their contract should be with the US company and not with the Canadian company. And often we have seen people miss that and say, it's just a contract, but for tax purposes, I want this under this entity. Doesn't work. You need to make sure your agreements are in place, you're right. Right? So your contracts with your employees are with the right entity, which will get taxed. Your contracts with your customers are with the right entity, which will get exposed to taxation in that country, right? So if you have a Canadian entity which has agreements with your US employees, guess what? Your Canadian entity is going to have tax issues down the line or will get exposed to US taxation. Similarly, if you have contractors there, just make sure it's with the contractors with the right entity. And also deciding, like Namir alluded to, deciding where your IP sits. And there are tax effects when you move IP from one country to the other. So you need to plan ahead, think through it. Is this something that I want to do? Do I want to put it into my Canadian company, or does it make sense to have it in the US company? Or I put it in my Canadian company, but the US company actually pays a fees for it. And if it pays a fees for it, what does it mean? What does it look like? So modeling it out, thinking through, and that before you put things in place, super important. Structure should also be more financeable. So like we talked about, should it be equity? Should it be debt? What does it mean from a tax perspective? So if I put debt in, I would be reducing the cost, reducing the taxes in the US because there's a deduction there. But it also means there's an income on the Canadian side. So what if my tax rate in Canada is higher than in the US? What does it mean? Right? So modeling it out, sort of thinking through every decision you're making uh, forefront and not after the fact. Because again, unwinding and changing later is much more costlier than doing it right the first time. Right. Okay.
Yeah, and with founders, they get super excited about the business that they're building, and they're really excited about how maybe they're disrupting the industry or they're bringing something new to the market that they are so focused on building and growing and getting the right engineers, the right team in place to help them scale and getting the right financing. But I think this is why the conversations in our area in tax are actually quite critical early on, because things will change. Things will change in terms of where you want to be. And you want to make sure that you're not only supporting where the business is today, but are you supporting, future fundraising and exit opportunities? Without hopefully requiring any sort of major restructuring. And you want to be able to be growth ready. You want to be flexible enough to accommodate, as you continue to expand and grow and maybe change your business model. And I would also say, be, try to find ways to be less ambiguous about where you want to go as a business and answering questions at the ownership level in terms of depending on obviously what's the right ownership and investor profile for your business, but understand where do you also want to be as an investor today, 5 years from now, because all those variables in the equation will impact ultimately what's going to be a good durable structure that's going to work for you today and in the future as you continue to scale the business.
Absolutely. And I think one of the things that I think about or comes to mind when we think about structures is the kind or the citizenship and the residency of the investor. Which vehicle are they coming in with? So as in if they want to invest through their corporation or are they individually coming in, that matters a lot. And when you have both, because Canada and US have this border, so it's pretty easy where Canadians are investing in US businesses or Canadians are getting more US investors. So it's super important to look through that and create avenues for both of them to invest. So if you are a Canadian company and you want US investors, you need to think about how you're going to get the investor in, what would make sense for them. Because a US investor might not want to get in through the Canadian company. So you might have to create another avenue so that they can tap from their perspective, it's tax efficient to get into your structure. So thinking about what kind of investor you need and what's the best way to bring them into the structure so that they don't have to pay more tax as well.
Yeah, I would agree with you, Sammy. It's both, that's a really important question as they're building the business. Do you want to have U.S. investors? What is the right structure that's going to attract those U.S. investors? And the other side of the equation is what is going to be the right structure if you want to exit the business and have an ultimate sale? Because a U.S. buyer will want to have a different set of answers to say what is the right structure that I'm going to buy into, versus what a Canadian investor is going to want to have. And I would also add, even before you get to that place, I think with the current ownership that you have, it's important to ask questions to the Canadians and say, we had orcas jumping in Vancouver earlier this weekend and asking them, are you happy with being in Vancouver in November when there aren't, whales jumping outside and it's sunny? Do you want to move to the US? Are you thinking about changing your jurisdiction, your tax residency, not just you, but your families? Because those type of questions, or as an owner of the business, do you think you're going to have to be spending a lot more time in the US to be building the business and not necessarily looking outside the window in Vancouver? So those are questions. They may seem silly or unimportant early on, but actually they impact ultimately where is the value of the business being built, where are the strategic decisions being made, and where do you see the business going in 2 to 5 years? And with that, we have a quick, practical, I guess, founder checklist that summarizes some of what we've talked about. And that is, starting with determine whether you already have a U.S. tax footprint. So don't assume, as Savneet mentioned earlier, that tax is going to start with incorporation, having, an entity or just having a brick and mortar place in the U.S. Decide what your U.S. entity is actually supposed to be doing. So if you're hiring, if it's doing sales or contracting or development or even fundraising, make those decisions early about what is the U.S. entity actually doing. Be very deliberate with your funding model. Don't let it emerge accidentally. And I say this because often what happens is, again, things are moving at lightning speed for founders. So they're making decisions of how they're financing the growth of the business. But there are some really serious consequences there that you want to have early on. And so be very deliberate about how are you funding the business and how do you want this to change going forward. And make sure you're aligning your profits with substance. So ensure the transfer pricing and the legal arrangements actually reflect your economic reality. And do prepare for diligence early. Don't wait until an actual exit is happening or you're looking for that financing round. So, identify exposures and build for the next stage. I want to say, we did talk a lot here about kind of the legal and tax pieces, but this is really about a growth discussion, for a lot of tech businesses. You're thinking about, where is my footprint? Where is my funding? Where's my profit allocations? How do I get diligent ready? But you really want to make sure that your structure design feeds directly into your ability to scale the business. You want to raise capital and ultimately, hopefully, succeed in the US market. So it's about getting this right early and hopefully avoiding problems so you can move. You are moving fast anyways, but you want to make sure that you're raising capital more efficiently. And as Savneet mentioned earlier, not having to go back and fix the past or the structure and having more time to really build into the future. So don't wait for the structure to catch up with the economic realities of your business. Build that structure that's going to keep up with where the business is going. I think the U.S. market is a tremendous opportunity for Canadians, but it is complex. It is an evolving landscape. As Savneet mentioned, there are 50 states. You're basically dealing with 50 different jurisdictions, almost countries. So understand the rules, be ahead of them, anticipate what are the investors going to be asking you, what are their expectations, and ultimately you want to build a structure that aligns with your business reality and position you for long-term success. And with that, we'll go into some of the questions. We could start. I think I'll start with the first question here. So we're a Canadian SaaS company with U.S. subsidiary that provides cloud-based services to customers worldwide. Under the regulations, how do we determine whether our income is U.S. or Canadian source, and how do we plan for this? So we brushed on it very briefly. So under the 2025 proposed regulations, the sourcing of income from cloud and the SaaS type transactions, they're going to be determined by where the service is performed. So not where your customers necessarily are located. So the regs are set up to have a three-factor formula that you want to look at. So one is personnel. So where are your employees who are developing or managing or delivering the cloud service? Where are they located? The other two would be tangible and intangible property. So, for example, with tangible property, if you have servers or hardware that is used to provide the service. And then intangible property, again, this could be where is the R&D, where is the software development that is supporting where the services are being performed. So if you have a US subsidiary, and there's a team, there are servers or R&D that is being performed in the US, then you could say, well, a significant portion of your cloud income will be treated as US source income and subject to US tax, even if your customers are located outside of the US. So this means that your funding and profit allocation and transfer pricing, all those elements that we discussed, they really need to be lined up to reflect that economic reality, to show that the value is actually being created in the US. So you'll want to make sure also that the US entity is properly capitalized, and that there's intercompany agreements, as we mentioned earlier, and that there's documentation to support this. You don't want to be in a position where you're failing to align your structure with these new sourcing rules so that the IRS could challenge it or deny deduction.
Okay, so there's another question here. It says, I'm working on establishing a reseller in the US. What does this do to me? I have a corporation in Canada and I've registered a subsidiary in the US, but have not made sales in the US since establishing that in December 2025. So I think the fact that you have a US subsidiary, that means you have a US filing. And even if it has no activity. But then if you're trying to establish a reseller, by that I'm assuming that you're trying to be the reseller yourself. And depends on, again, who's signing the contract that we talked about. Is it the Canadian company? Is it the US company? If US company is going to be the reseller, from a sales tax perspective, you would probably have to get reseller exemption certificate so that you're not subject to sales tax, but that doesn't take away your income taxes, right? So you would have to look through the rules for income taxes and say, am I taxable in the state? Or which entity is actually taxable? If the Canadian entity is a reseller, then your Canadian entity is exposed to that taxation. If it's the US company that signed the contracts, then US company is the one that is going to get exposed to that tax. So just making sure it's in the right entity, it's important because that determines your tax consequences.
Yeah, and just to add to that, Savneet, I think, going back again, be very clear on delineating who is doing what between the Canadian and the US entity in terms of value creation. Presumably, you're going to have some transfer pricing agreement between the two entities that'll allow you to be a US reseller, but that has to actually reflect the economic reality of how the US entity is doing business and what business it is actually doing in comparison to the Canadian entity. Got another question here. If a company already has US customers, but no US employees, what is the biggest risk area, federal or state? I can touch on that, and Sonia, you can also add to it. So I would say state risk is probably the bigger risk here. I think a lot of states are going to impose, income, or they could have sales tax. That could be based on the economic nexus, so which can be triggered by sales alone, even if you've never set foot in the U.S. So even without employees or physical presence. So states, a lot of them don't follow the U.S.-Canada treaty. So you may end up owing estate taxes or at minimum have some sort of filing obligation even if you are protected at the IRS federal level.
Uh, Yeah, it's important that you understand the state tax effect because state rules are so different between states. So you could sometimes end up being taxable on the same amount in two states, right? Or not be taxable at all because one state might say, I'm going to tax this as a tangible property, and the other might say, I'm going to tax it as a service, and they might have different rules. So you have to fully understand that. So I would say federally, the laws have become clearer because there's so many people filing for it. But when you look at the states, every state has a different rule. So you got to figure out what is the tax effect, right? And also there are states that are very aggressive, right? Like some of them that I count are like California, Texas, New York. You will get a notice if they hear wind of like, okay, you're doing something in the state, right? And that could be anything. That could be your payroll taxes or you paying something to a contractor and giving them a 1099 in the US, for example. That's the form you give to your contractors if you have a US contractor, right? So the for me, I just feel like it's probably the states as well, and I agree with the mayor. Federally, I think that's one thing to deal with, but when you're dealing with 50 more things, obviously it becomes more complex and more, as you see, the way the economy is, I would say the states need more revenue, so they're definitely going after the taxpayers.
And I would say there's a two-pronged test with states in your industry. I would say first is how is that state going to characterize your income? Like if it's a platform as a service, if it's a software as a service, how are you first going to characterize it in that state? Because each state will characterize it potentially differently. And then two, now that we know how it's going to characterize it, will you then tax it? So if it, for example, characterizes it as a service, is that service even taxable in that state? So there's no one rule that's going to work for all 50 states. And with that, hey, please do complete the survey and let us know how we can improve and any other topics you'd like us to cover. We really appreciate you attending with us today. And just as a reminder, because we did a tech-focused discussion today, we do hope and we are inviting you to join us next week to continue the conversation at Web Summit in Vancouver. Savneet and I will be there all next week. We're also going to have a hands-on masterclass and spending time at our booth talking with founders and operators and tech leaders about what's happening here in terms of what the intersection of tax and technology. So if you want to stop by for a quick 15-minute discussion or attend the masterclass or book a time with any of our senior team to talk about your challenges, we would genuinely love to meet you. Hopefully today sparked some ideas or questions. Web Summit is one avenue to take the next step. So we're really looking forward to being there, Savneet and I, and hopefully meeting you in person. Savneet, thank you for today,
Absolutely.
and
And I
thank you
wish I
for
see
joining
those.
us.
Yeah, and I was gonna say, I wish I see those orcas when I come there, but
It might still be around. It might still be around.
yeah.